In the last 48 hours, gold did something the market hates because it exposes the wiring behind the price. 40 an ounce, and it did it while the exchange that clears a huge share of the paper market quietly made it more expensive to hold the position. That combination is rare. Price breaks resistance, and at the same time, the cost of leverage rises. It is a balance sheet event wearing a technical mask. A week ago, the story looked completely different. Gold had been trading at record territory after tagging a reported peak near 5,726 an ounce. Then it snapped lower with a kind of speed that makes even veterans look up from their screens. On January 30th, 2026, market commentary described gold falling about 11% and silver plunging about 30% in a single day, erasing an estimated $7 trillion in market value across the metals complex and the positions built around it. That's not a normal correction. That's a systemic shakeout. The kind that only happens when collateral rules and crowded positioning collide at the same moment. And yet here we are, watching the same metal climb back over the very level that was supposed to become the new ceiling. They said this could never happen at these price points. But efficiency disappears when margin, collateral, and delivery collide. Institutions already understand this. Most people don't. The most important part of this story is not the candle on your chart. It's what the plumbing is signaling underneath it. What I'm about to lay out changes how you interpret every headline about gold from here. Welcome to Signal and Structure, where we decode what matters before it becomes a headline and where we separate price from mechanism. If you've been here before, you already know we don't chase noise. We track the footprints. If you're new, settle in like you're listening to that wise elder who speaks softly but never wastes a sentence. And as you listen, drop a comment with where you're watching from, because this market shift is global and the map matters. One detail that amplified the January 30th shock was how quickly the narrative flipped. In the days leading into that sell-off, gold's rise had been framed as almost inevitable. Debt worries, geopolitics, and the slow erosion of confidence in paper promises. Then, in a single announcement window, the macro story changed tone. Reports described President Trump naming Kevin Warsh as the next Federal Reserve Chair on January 30, a choice many traders interpreted as more hawkish than expected. Whether that interpretation holds over time is almost beside the point. In markets, expectations are the spark. Positioning is the fuel. When the spark hits a crowded trade, you get fire. That snap matters because it reveals where leverage was hiding. If a market can lose 11% in a day, it means a large portion of ownership was not long-term unfinanced conviction. It was financed exposure, and financed exposure has a clock. The moment funding terms, volatility limits, or risk models change, the position changes. This is why the drawdown felt impossible and yet happened anyway. The sell button wasn't always a choice. For many accounts, it was a requirement. This is also why the $7 trillion estimate is so revealing. Gold itself is not physically transacting $7 trillion a day. That number captures the ecosystem, futures exposure, options gamma, ETFs, miners, and the credit that sits behind those trades. When that ecosystem convulses, exchanges look at clearing risk, brokers look at client risk, and risk desks look at correlation assumptions they thought were stable. A margin hike is simply the public face of that private recalculation. Now let's reconstruct what actually happened next, with dates, numbers, and the kind of detail that reveals intent. On February 12, 2026, COMEX gold futures saw estimated volume near 178,099 contracts, and open interest around 403,917 contracts, up roughly 3,000 on the day. Those are not small numbers. A single gold futures contract represents 100 troy ounces. Multiply that out, and you're looking at tens of millions of ounces of paper exposure sitting in outstanding positions. Even if most of that never comes near delivery, it tells you something important. Participation is not fading, it's intensifying. 40 an ounce in market reporting. That's not a random print. 5,000 is psychological resistance, sure, but it is also operational. Many risk systems, many option strikes, and many structured products are built around round numbers. Crossing it changes hedging flows because protection that was out of the money becomes a live wire and dealers have to adjust. Then the other shoe dropped. CME Group raised both initial and maintenance margins for COMEX 100 gold futures to 9% from 8% for accounts not flagged as heightened risk. Silver margins were hiked even more aggressively. COMEX 5,000, silver futures initial and maintenance. Margins to 18% from 15%. These changes were scheduled to take effect after the close of business, which is how exchanges avoid instant chaos while still forcing participants to post more collateral almost immediately. Here's where it gets interesting. When an exchange raises margin, it does not predict direction. It changes who can stay in the game. Leverage is the oxygen of futures markets. Reduce oxygen, and weaker positions suffocate first. That can create forced selling into weakness. but it can also clear the deck for stronger hands to absorb and then drive price higher once liquidation exhausts. A margin hike during or right after a breakout attempt is a stress test. It tells you volatility is not a side effect. It's the condition the market is now living in. There was also a deeper structural change that most people missed. CME changed its precious metals margin methodology on January 13th, switching from fixed dollar margins to a percentage of contract value system. That sounds technical, but it's a regime change. When price rises, required collateral rises automatically. In a high price environment, the system tightens itself. It makes parabolic moves harder to sustain for leveraged speculators, while simultaneously making any surviving bid more resilient because it is financed under harsher terms. So the central mystery becomes this. If gold is too volatile, if it needs to cool off, why is it climbing back through resistance while the rules are getting stricter? The answer is that volatility is not the same as weakness. Volatility is often the signature of a market being repriced. To see why, you have to zoom out and look at the hidden pattern. When this combination appears, major level breaks, margin pressure, and a divergence between paper flow and physical signals, the outcome has repeated across decades. In 1979, gold accelerated as inflation and geopolitical stress collided with distrust in monetary policy. Volatility exploded, authorities tightened conditions, and the market printed moves that looked like the end of the world and then the end of the rally, sometimes in the span of weeks. Result, gold didn't move in a straight line, but it redefined what the public thought money protection meant, and it forced institutions to treat gold as more than a curiosity. In 2011, after the global financial crisis and multiple rounds of monetary easing, gold surged to then record levels. Futures positioning expanded, volatility rose, and the market saw sharp corrections that looked final. Result, gold carved a new range, and the conversation shifted from why gold to how much gold. Not because everyone became enlightened, but because the system made the question unavoidable. In 2020, the playbook reappeared under a different costume. Crisis, liquidity injections, record debt issuance, and then a scramble for collateral. Gold broke out, pulled back on violent moves, then stabilized as real rates and fiscal policy became the true drivers. Result, central banks and institutions treated gold less like a trade and more like an insurance policy against policy error. Now in 2026, it's happening again, but with a sharper edge. Because the price level is higher and the global system is more fragmented, we are watching the same pattern. A surge, a forced reset, and then a recovery that tells you the bid is structural. This is not opinion, this is pattern. So who is positioning and why does it matter more than the daily headline? Start with the official sector. 3 tons of gold in 2025. That's below the 1,000-ton pace of the prior 3 years, but still far above older historical norms. In the fourth quarter alone, net purchases were about 230 tons, up 6% quarter over quarter. And the largest name buyer for the second consecutive year was the National Bank of Poland, adding 102 tons in 2025. That's not retail enthusiasm. That's reserve management. And reserve managers think in decades, not candles. Then there's China. Market reporting noted the People's Bank of China added 40,000 troy ounces in January, marking the 15th consecutive month of official bullion purchases. On its own, 40,000 ounces is not huge relative to global turnover, but the streak matters. The signal is consistency. It tells you policy, not price, is driving the accumulation. Now look at physical reference pricing in the East. 670 on February 13th, 220 RMB per gram. In other words, the physical reference price in the world's dominant physical hub has been living in a new regime for weeks, not days. This is the part no one is discussing. A breakout above resistance in the Western paper market is dramatic, but physical pricing has already been auctioning a higher reality twice a day. When paper finally catches up, it looks like a surprise. For physical markets, it looks like convergence. Now layer the exchange behavior on top of that. CME margin hikes are a response to volatility, but they are also an acknowledgement that price swings are creating clearing risk. Clearing risk appears when the market is carrying positions that can't be comfortably financed at the new price level. That is a polite way of saying leverage got too thick. At the same time, headlines blamed speculation and pointed to Chinese market tightening. Whatever you think of the framing, the mechanism is the same. When price moves too far, too fast, the system raises the cost of carrying it. But here's the twist. If price continues higher anyway, it means the buyers are not just levered momentum traders. It means there is demand that can survive tighter collateral rules. Now we get to the dislocation, because this is where the data tells 2 different stories at once. On one side, you have paper gold, futures, options, swaps, and structured products whose settlement is overwhelmingly cash-based. whose positions can be created and closed without moving a single bar, and whose primary constraint is margin. In that world, a margin hike is a gravity switch. It can pull price down simply by forcing liquidations. On the other side, you have physical gold, benchmark auctions tied to delivery in certified vaults, premiums that appear when metal is scarce in the right location, and sovereign accumulation that doesn't care about daily volatility. In that world, the constraint is not margin, it's metal. When paper price collapses, but physical benchmarks and official buying remain firm, you get a spread that should not exist in a perfectly functioning market. And yet, it can exist longer than people think because paper is elastic, physical is not. This is why the gap cannot persist indefinitely. Either paper price must converge toward the physical and policy bid, or physical demand must break. Historically, when central banks are accumulating and exchanges are tightening collateral, the path of least resistance is not a sustained collapse in physical demand. It is a repricing that clears paper excess and then reconnects. Let's anchor that with numbers because numbers make the mechanism visible. Start with margin math. A gold futures contract is 100 ounces. At $5,000 per ounce, the contract notional is about $500,000. An 8% margin implies roughly $40,000 of collateral. A 9% margin implies about $45,000. That is $5,000 more per contract. 10 contracts demands $50,000 more dollars. 100 contracts demands $500,000 more dollars. That is how margin changes turn into liquidation waves. Not because opinions changed, but because collateral requirements did. Now look at open interest. Around 403,117 contracts of open interest represents exposure tied to over 40 million ounces of gold in outstanding paper positions. Again, that does not mean delivery is coming for 40 million ounces. It means the paper market is carrying a massive shadow of claims on the price. When volatility rises, the collateral system decides who gets to keep their claim. Now contrast that with official sector buying. 7 million troy ounces. Put differently, 1 year of central bank net buying is on the order of 2/3 of COMEX open interest exposure, but central bank buying represents real metal moving into reserves, not paper claims being netted out at the end of the day. Add the Shanghai benchmark context. 220 RMB per gram on January 29th, followed by mid-February prints still above 1,100, tells you the physical clearing price has not returned to a pre-breakout world. It is normalized higher. That matters because physical benchmarks are not set by slogans. They're set by bids for deliverable lots, and then there's the demand stack. Financial reporting on World Gold Council data highlighted that investment demand in 2025 surged to roughly 2,175 tons, powered by ETF flows and bar demand, even as central bank buying moderated from the prior 3-year pace. That broadens the base. You're not relying on one buyer class, you're seeing official sector demand, investment demand, and regional physical pricing all interacting. But it also creates friction, because paper markets can scale exposure instantly while physical markets scale by logistics, refining, shipping, and vault capacity. That's how you get moments where the price says one thing and the market says another. If you've ever wondered why gold can be called a haven and yet trade like a risk asset on certain days, this is the reason. On a liquidity day, paper gold behaves like a funding instrument. On a confidence day, physical gold behaves like money. So what does this mean going forward, without turning analysis into prediction theater? Historically, when gold breaks a major resistance level, gets shaken out by forced selling, and then reclaims the level under tighter margin rules, it often signals the market is transitioning from speculative upside to structural repricing. In that transition, violent swings do not mean the thesis is broken. They mean the leverage layer is being scrubbed. There are 3 scenarios to watch, and none of them require certainty. They require indicators. In the conservative scenario, volatility remains high, margins stay tight, and gold oscillates around the 5,000 zone while the market digests positioning. In that world, you watch open interest. If open interest falls meaningfully while price holds above the key level, it implies weak hands are being cleared and the base is strengthening. You also watch the Shanghai benchmark prints and any sustained physical premiums. If physical reference prices remain elevated while paper churns, the structural bid is still present. In the moderate scenario, gold stabilizes above resistance and then grinds higher as the collateral system adapts. In that world, you watch for exchange margin changes to stop escalating, not because risk disappeared, but because the market has normalized at a higher level. You also watch official sector reporting. Continued net buying, even at a moderated pace, tends to reinforce the floor. In the aggressive scenario, the dislocation widens first, not because gold fails, but because something else breaks. Credit stress, currency volatility, or a sudden demand for collateral that forces asset sales across the board. In that world, gold can drop even as its long-term role strengthens. because in a scramble for cash, everything gets sold. The key indicator then is the speed of the rebound and the behavior of physical benchmarks. If physical holds, while paper cracks, history leans toward repricing rather than collapse. Now let's make the mechanism simple without dumbing it down. Think of the futures market like a highway built for speed. Leverage is the engine. Margin is the fuel requirement. When the exchange raises margin, it's like raising the fuel standard overnight. Cars that were barely running stall. That creates a pileup. Prices whip because positions are being liquidated not by choice, but by rule. Meanwhile, the physical market is like freight rail. It moves slower, but it carries real cargo. Rail does not care about fuel standards in the same way because it's hauling metal, not just exposure. When the highway gets congested and the rail line keeps moving, the price you see on the highway screens can become temporarily disconnected from the value being established by freight. The longer that disconnect persists, the more pressure builds for convergence. Not because resistance lines are magical, but because a breakout at a new price regime forces the financial system to renegotiate collateral, risk limits, and reserve behavior. The moment gold lives above 5,000, every risk model anchored to the old range has to be revised. Every derivative book marked to that price has to be financed at that price. Every central bank holding is suddenly worth more, and every institution that ignored gold has to explain why. That is why the narratives sound contradictory right now. One camp calls it speculative excess, another calls it monetary awakening. The data suggests a third explanation, a market moving from price discovery into collateral stress, where gold's role shifts from a trade into a balance sheet asset. And collateral is increasingly the centerpiece of the global system. Bonds, currencies, and commodities are all being valued not just by their cash flows or supply, but by their role in funding chains and reserve decisions. In that context, gold is unusual. It has no issuer risk. It is not someone else's liability. They are not buying a bargain. They are buying a property, settlement without counterparty. So the divide ahead is not about being bold or timid. It's about watching the right layer of information. Most people watch the price and feel emotions. Institutions watch the plumbing and adjust exposure. Those who understand this watch margin changes, open interest, and physical benchmarks as a single story. They notice when the exchange changes its methodology on January 13th. They notice when margins go from 8% to 9% and silver margins jump from 15% to 18%. 220 RMB per gram on January 29th and still sits above 1,100 in mid-February. 3 tons in a year, and when Poland alone adds 102. They notice a 15th straight month of official buying out of China, and they notice that price reclaimed 5,000 anyway. Those who don't understand it will either dismiss the move as hype when it rises, or declare it dead when it falls. They will react late because their framework is emotional, not mechanical. The information gap becomes a wealth gap in markets, not because anyone is smarter, but because some participants are watching the signal and others are watching the noise. Retail moves last. It's not an insult, it's a structure. One more set of signals can confirm which scenario is taking shape. Real yields, the dollar's trend, and ETF flow data. When real yields rise and gold holds firm, that can signal the bid is not rate sensitive. When the dollar strengthens and gold refuses to break, it suggests diversification demand is overpowering currency headwinds. And when ETF flows turn positive after a liquidation week, it can mark the shift from panic to accumulation. So as gold reclaims resistance, don't ask whether the chart looks bullish or bearish. Ask what the system had to do to keep functioning. Ask who can still hold positions after a margin hike. Ask why physical benchmarks and official buyers keep showing up even when paper shakes. And ask what happens historically when a market survives tighter collateral and still refuses to go away. This is signal and structure, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether this unfolds. The question is whether you can recognize the mechanism while it's still forming.